the worst proposal of all, a tax on unrealized capital gains.
Hello everyone, I'm John with JP Strategic Investments, and today I'm going to go over the proposed tax on unrealized capital gains. I'll go over what it is, why it's a bad idea, and also why it's probably unconstitutional. And lastly, I'll go over how the proposed tax could have crushed GameStop investors and likely bankrupted the company. So, as all of you probably know, whenever you sell a stock, option, or any other investment for that matter, you have to pay taxes on the profits. Although you don't pay taxes on any investment until you actually go to sell it. A stock you own, for example, may have increased 50% over the course of this year, but if you haven't sold the stock, then you don't actually pay any taxes on it. Well, that could change very soon if a tax revision proposed by many House and Senate representatives, as well as Treasury Secretary Janet Yellen, becomes a reality. They want to impose a tax on unrealized capital gains, meaning that every year if any of your investments have increased in value, you will be taxed on them even if you haven't sold them. Now, anyone with any investment experience, especially stock market experience, knows that you aren't guaranteed any profits from any investments until you sell. Every investor has had those moments when a stock shoots up and they hold only to see the stock eventually drop right back to where it was before. So if it's common sense that an investor doesn't actually benefit from an increase in value unless they sell, why would anyone propose a tax on unrealized capital gains? Well, I'll let newly appointed Treasury Secretary Janet Yellen tell you herself.
Separate and apart from the Biden administration's proposal to double the taxes on capital gains, some are suggesting that we start to impose taxes on unrealized gains. An asset appreciates and we charge a tax on that, even though there's no liquidity event, there's no sale, there's no actual realized gain. We'll, I guess, have a mark to market, if that's even possible in some cases, and impose a tax on that. So my question for you, Dr. Yellen, is without getting into any particular bill, do you support the idea of taxing unrealized appreciation of assets?
Well, I do believe that capital gains should at some point be taxed. Right now, step up of basis at death provides a route by which a very large share of capital gains are never taxed.
So in case any of you guys aren't familiar with step-up in basis at death, current tax laws state that when a person dies and leaves their assets to someone else, the cost basis of the assets, including houses, stocks, and other investments, is increased to the current value of the assets. Let me explain this a little further. When you buy a stock, your cost basis is the price at which you initially buy the shares. Then, if the stock goes up and you sell the stock, you pay taxes on the amount that the stock has increased in value from your cost basis. Or in other words, you just pay taxes on the profit of the sale rather than the entire amount of the sale. So with a step up in basis in the case of a stock, when the person who inherits the stock goes to sell, they only pay taxes on the amount that the stock has increased since they inherited the stock, rather than the entire amount that the stock has increased from when the original owner purchased the stock. So what Janet Yellen is really saying here is that the government is missing out on taxes when people die and leave their assets to their children, so they should just tax them every year that they go up in value so that they aren't missing out. If that's not pure greed, I don't know what is. Now, as an investor, I've learned that even if you don't agree with a proposed policy or a decision that a company makes, you still have to assess how likely it is to happen and how it would affect your investments if it were to happen. So let's first go over how likely this is to happen and then go over how it would affect the market. The first point I think we need to address here is whether or not the tax revision is even constitutional. While most of you understand how capital gains tax and federal income tax works, most of you probably aren't aware that federal income tax didn't always exist, and when it was first proposed, it was actually unconstitutional. In fact, an amendment had to be passed in order for the federal government to legally be allowed to impose a federal income tax. This is because the country was initially set up in a way that the states retained most of the power and the federal government had very limited power. Before the 16th Amendment, the federal government could only actually tax the states rather than the individual citizens in each state. Depending on the tax, they could either do this based on the population of the state or keep every tax the same for each state. Well, as the federal government tends to do, they started spending more money than they actually had. So the 16th Amendment was created so that the federal government could directly tax the income of individual citizens. This is what allows the federal government to impose a federal income tax as well as federal capital gains taxes. Although the amendment specifically states that the federal government has the power to collect taxes on income. In my opinion, it would be very hard to argue that the increase in value of an asset is actually income unless the asset is sold and the investor actually receives the profits. This would mean that a federal tax on unrealized capital gains would be a direct tax on citizens not based on income and would therefore be unconstitutional. This, combined with what seems to be very heavy opposition from most Republican congressmen, would lead me to believe that the likelihood of this policy becoming a law would be relatively low. That being said, I'm not a federal judge, and the Democrats do control the House, Senate, and presidency. So theoretically, if the policy is deemed constitutional, then the Democrats should have no trouble passing it into law. So with that said, let's take a look at how it would actually affect the market and investors if it were to pass. Now, as far as I can tell, there hasn't yet been a specific percentage proposed for the tax, but if the idea of the tax is to make up for the lost taxes on step-up and basis, I think it's safe to say that the tax rate would have to be somewhere close to the lowest long-term capital gains tax of 15%. To be conservative, I'll just use 10%. Keep in mind, though, that again, the Democrats control both the House and the Senate, so they don't really have to negotiate on a percentage here with the Republicans if they wanted to pass this tax revision. But I do think that they would at least drop it down to around 10% to make it seem somewhat reasonable. So how would an annual 10% tax on unrealized capital gains affect the market? Well, for one, it would increase the frequency of trading in the market. Many investors currently hold on to stocks for longer periods of time because they pay a lower tax rate than on shorter-term trades that last less than 1 year. Well, if an investor knows he's going to be taxed on his unrealized gains even if he doesn't sell the stock, then there's much less incentive to actually hold on to the stock. This could also apply to the housing market depending on how interest rates perform, because homeowners will now be incentivized to refinance every year that their home increases in value and pull that cash out if they're going to be taxed on it anyway. This way, if the house decreases in value in the next year, at least they didn't pay taxes for nothing. As for the stock market, we would likely see a larger drop in the market in general as well, with stocks becoming less attractive and people shifting money into fixed income like bonds and annuities. If you thought the 10-year yield jumping to 1.7% was bad, this would likely be even worse. Finally, the last thing it would do is create very predictable large sell-offs in certain stocks that have appreciated quickly towards the end of the year, as investors would not want to get caught paying taxes on a spike in value only to see that value disappear shortly into the next year. I think the best way to explain this is to use GameStop as an example. Imagine if what happened with GameStop had occurred at the end of the year, and on December 31st, GameStop stock had closed at $400 per share. Then, over the next week, it dropped all the way down to $50 in a very similar way as it did earlier this year. Well, if there was a 10% tax on unrealized capital gains, then every investor who owned GameStop when it closed at $400 per share would have to pay taxes on all of their gains up to $400, even if they held the stock all the way down to $50 per share. This would mean that unless you had a large portion of cash in your portfolio on the side, many investors would likely have to sell most of their shares just to pay the taxes on the unrealized gains up to $400. This would create even more selling, driving the stock down even further. On top of that, the company itself also owned shares in the company, and it would be subject to the same taxes. In a worst case scenario, if the stock had continued to fall even further, this would have potentially bankrupted the company. That would in turn make the shares worthless, and now investors who had lost their entire investment would still owe huge amounts in taxes, which could very well put them in long-term debt. This is not healthy for the market and could create some very scary situations, as I have just demonstrated. So I think from a constitutionality standpoint, as well as just a common sense standpoint, a tax on unrealized capital gains is not a good idea at all, and everyone should be aware of this so that if this proposal does move forward, we can do everything in our power to stop it. I hope you guys found this video helpful, and if you did, please like the video and share it with someone else that you know, regardless of whether they're an investor, because this is going to affect more than just investors in the stock market. As always, if you find content like this helpful and you're interested in stock market analysis, please consider subscribing, and other than that, see you next time and have a great day.